Hi guys, this is Aditya Vora here. Hope all of you are doing well. Let me throw the name of a country and tell you what the first thing comes to my mind in terms of what the country is famous for in what it makes. To start with, when you say China, the first thing which comes to your mind is factory to the world. For India, software capital of the world or pharmacy to the world. For Brazil, it is sugar. For Africa, it is Arabica coffee. Germany, engineering and automation. USA would be capitalism. Dubai would be tourism. Saudi Arabia and the Gulf countries would be supplier of oil to the world. Well, the fortunate and unfortunate part is that the above chronology has been constant over many decades, if not centuries. A Saudi Arabia or a country in the Arab Peninsula will always be known by its oil reserves. That won't change for the next century at least. However, will oil be as relevant as what it was 20 years ago? Or on a lighter note, will USA invade countries just for oil 20 years later, considering oil's relevance will be much lower? It is this constant ever-evolving world and new technologies which makes certain countries redundant. Take for example Europe. Few decades ago, anything related to technology or automation was linked to European countries. Siemens, ABB, Volkswagen, all of them are European companies. The world could not do without them. Now just fast forward to 2023. Not only China, but also countries like India have achieved a quantum leap in manufacturing and automation. The cost advantage in terms of labor and power is enormous in countries like India and China. On a lighter note, the way things are going for many countries in Europe, it can at best be the tourism capital of the world. Maybe a cold and scenic alternative to Dubai. While different countries have had their dominance in providing particular goods or services, one country stands out. There are no prizes for guessing the country I am referring to. It is China. China makes everything required by the world. Basically, it is the factory to the world. You name the commodity, goods, services. China is the largest producer of practically everything. You know, India and China had the same per capita GDP in 1990. However, it was the next 2 decades that made the difference. China's per capita GDP today is 5.5 times more than India. Now, there are two ways to look at the above GDP comparison. One interpretation is China is way ahead of India and the catch-up will be difficult. However, the other smarter and opportunistic way would be that China at this point in time is stagnating under its own weight, with COVID making things worse for it in terms of its image, while India has been the benefit of low base and is at an inflection point. In stock market parlance, it is betting on a fast growing small cap versus a near large cap. The thing is that a large cap will never grow at the same pace it did when it was a small cap a decade ago. But for a small cap, if the right ingredients are in place, it will rocket. The time for India to rocket into orbit has come. While the above discussion about economies makes me look very smart, but my job is to find the right companies and the right sectors before it becomes news. So friends, let me list out certain undiscovered high-risk companies which are likely to benefit from India's growth story. Please do note that these stocks are small caps and are very risky in nature, and I am not recommending to buy these stocks. The sector which I am talking about is the electronics manufacturing sector or the EMS sector. Now, while Dixon and Amber enterprises are the best proxies to the contract manufacturing and the Make in India story, the problem lies in the valuations. Dixon has been growing at 20 to 30% over the past 2-3 years but has a valuation multiple of 100 times. Just on basic mathematics, Dixon must grow every year consistently at 30% for the next 4 years for it to trade at a multiple of 45 to 50 times. This assumes that the stock price is stagnant and does not grow. The problem is that the multiple re-rating is over, and only way the stock price can go up is if the company reports strong earnings growth. And when I say strong earnings growth, it is in excess of the average 30% which is reporting in the past. If you look at Amber Enterprise also, Amber on the other hand has dismal return ratios. I mean, how on earth can anyone be comfortable with a stock which barely gives lower double-digit returns on capital and to shareholder and commands a 55 times price to earnings multiple? How can anyone pay 55 times multiple to a company which barely has lower double-digit return on capital and its shareholders? Friends, Amber and Dixon are great companies, but the problem is valuation and growth. That is not in sync. So friends, I came across two stocks in this EMS space which could be potential multi-baggers with strong earnings growth. The first company to play the contract manufacturing sector is this small cap company called Focus Lighting and Fixtures Limited. Just to give you a brief, Focus Lighting and Fixtures Limited is engaged in the manufacturing and trading of innovative LED lights and fixtures with focus on indigenous high-end retail and architectural lighting at a competitive cost. In the last 5 years, the company has started focusing on new segments like home lighting, infrastructure lighting, and railway lighting. Focus on innovative technologies like IoT. In terms of revenue split, manufacturing of light accounts for 45% of revenues, while trading of lights accounted for the remaining 55% of revenues. The company boasts of clients which include BMW, Arvind, Dune, IKEA, Reliance, Tata Motors, Gas, Mercedes-Benz, amongst other many marquee customers. You know, a breakthrough was offered through the production of their innovative reflector technology with a higher efficiency level resulting in substantial reduction in power requirement. The company has shown strong growth in revenues as well as earnings over the past 3 years. In fact, it was loss-making in 2021, while in 2022 the company turned corner with a profit of Rs 5 crore. 2023 was a blockbuster year for the company which grew by 300% to Rs 23 crores on a revenue of 170 crores. With return on capital employed and return on equity of 45% and 35% respectively, supported by strong earnings growth, paying a 40 times PE multiple makes sense for Focus Lighting and Fixtures Limited rather than paying a 100 time PE multiple for Dixon. The logic is simple. As the contract manufacturing sector picks up and the demand for lights and fixtures increases, small companies like these will benefit as they will get outsourcing and private labeling opportunities. Just like say a Blue Star or a Daikin AC or a Whirlpool washing machine or a Samsung TV don't have the bandwidth to make products and they outsource it to companies like Dixon and Amber, the same is expected in the lighting segment. Companies like Focus Lighting will lead the way in the lighting space. While Dixon and Amber are established companies with a sizable market cap and a high revenue base, the real juice in the EMS lies in these small caps, which are expected to continue their growth trajectory at a faster pace. Now, another company in contention is this company called PG Electroplast, which manufactures washing machines, air conditioners and coolers. Now, if you look at the business verticals, the product vertical, which comprises of room air conditioners, washing machines and air coolers, account for 62% of total revenues, while plastic molding for consumer durables and automobile accounts for 30% of total revenues, while the electronics and tool manufacturing account for the remaining percentage. The company has all the marquee clients ranging from Voltas, Lloyd, Whirlpool, Crompton and Daikin to name a few. Also, if you look at the financials, the company has grown its revenues by 8 times in 7 years, from a 263 crore revenue in FY16 to rupees 2160 crores in FY23. That gives it a 35% compounded growth over a 7-year period. Not only revenues, but EBITDA for the company has grown by 36% compounded during the same period. Also, if you look at the return ratios, the numbers look fairly decent when it comes to return on capital employed and return on equity, which are 17% and 22% respectively, as the company is focusing on growth. While the only issue with this company is the high debt which it has. PG Electroplast has a debt equity ratio of 1.5 times, which is on the higher side. The company, despite such high debt, can maintain a decent ROC is a fairly good indicator. PG Electroplast is also available at roughly 40 times price to multiple with strong growth on a relatively lower base. So friends, to conclude, while the opportunities are massive in the defense as well as the electronic space, what is important is to be cognizant of valuations. Buying companies in a buzzing sector with high valuations is a bad investment decision which will increase the gestation period of your holdings. Do let me know what your thoughts are on this. Thank you.